Let us continue discussing some of the terms in the insurance industry. One term is life annuity. So life annuity is it's an insurance product in which the policyholder will receive a series of payments for his lifetime after retirement. So say you're a salaried person and you have, during your service when you're employed, you have taken up this life annuity policy, and every month, say every quarter, you have invested some money in this policy. So after retirement, say you have retired 60 years, and say for example you have a lifespan of 8 years. So for the next 20 years, till the moment you die, okay, from the date of retirement till the day you die, the insurance company will be paying you a monthly so and so amount based on how much amount you have invested. For this, the policyholder has to initially pay a series of payments, and the more you invest, say for example every month you have paid 1,000 or every month 2,000, which means you'll be having a lot of money pulled up. Okay, and once you retire, you'll stop making the payments because you don't have salary. You'll stop making the payments. Now the insurance company will keep paying you till your death, no matter how long you live. Even if you live for 90 years or 100 years, that's immaterial. Till the moment you die, every month you'll be getting money. Okay, so the advantage of this product is it allows the policyholder to maintain a decent standard of living even after retirement. Even after not getting salary, you can maintain a decent standard of living because the insurance company will be paying you every month some amount. So in interviews, they'll ask you what is life annuity and what is the benefit of life annuity to the policyholder. So in insurance, there is a term called riders. This is also you should be aware of. Riders are supplementary benefits that are added to the primary life insurance policy. So that means the policyholder will get additional benefits besides the main benefit of life cover. They'll get additional benefits. But however, compared to the plain vanilla policies, these policies will be having higher premium. So they can ask you what are riders. You should be able to explain that. Then there is something called accidental death benefit and dismemberment. So these are supplementary benefits incorporated in the life insurance and health insurance policies. So accidental death benefit and dismemberment is an additional benefit paid in the event of death of policyholder due to accident. Okay, and dismemberment benefit is paid if the insured dies or loses his limbs or sight in the accident. So they can ask you what is dismemberment benefit. Then there is a concept called actuary, which we discussed briefly before. Actuary is a person who has expertise in the field of statistics and economics, and they'll be helping the insurance companies to do a risk assessment and estimate the premium to be paid, premium to be charged to the policyholder. So who is an actuary? Is the person who helps the insurance company in devising the policy structure, the premium structure. So if it is risky, they'll be charging higher premium. Okay, and if it's less risky, it will be charging less premium. Then there is a term called claim amount. So claim amount means the sum payable at the maturity of the policy. So in case of life insurance, it is paid upon the death of the policyholder to the nominee or legal heir. And in case of other insurance like medical insurance, the amount will be paid to the policyholder himself. So whenever claim is raised, the insurance company will not pay immediately. They'll first of all conduct a review to ascertain that the claim is valid. It's not a false claim because there are a lot of frauds here. So false insurance claims are produced. It is possible, okay? Say for example, you have not met with an accident. Say you have a accident policy, but you have not met with an accident. So what you do, you have a tie-up with some doctor, a small nursing home or some hospital. You produce fake bills, fake hospitalization bills and all. And then you can submit the claim to the insurance company. So that will be a loss to the insurance company. So even though you have not met an accident, you are claiming the amount. So to prevent these frauds, whenever a claim is raised, insurance company will be doing its own independent review to ascertain that the claim is false or not. Once it ensures that it is valid, then the amount will be disbursed in the name of the beneficiary or the nominee. Okay, that amount is known as the claim amount. Okay, so in interviews they can ask you what is meant by claim amount. Then there is a policy called fire and special perils policy. So this is a policy that safeguards against unforeseen loss caused by accidental fires, lightning, explosions, even man-made perils like strikes and natural calamities, storms, cyclones. Okay, banks usually take this policy. There is a comprehensive policy for banks that covers of which fire and special perils policy is one part, but they can take this independently also because banks have a lot of valuables, say in lockers. Okay. There are a lot of important documents when you give housing loans, there are a lot of the deposit of title deeds. So bank has to protect against fire and other accidents. Okay, so banks will be taking these sort of policies. So in interview they can ask you what is meant by fire and special perils policy. So then there is a policy called Keyman policy. So Keyman is a key employee. So in a company, he's an important employee or an executive. It's very important in the company. So important that their accidental death may adversely impact the company. Okay, so in such companies, they'll be taking what is known as Keyman insurance policy. So what this policy covers is, in case say that executive or that person has died suddenly, or there is some disability due to which he cannot function his offer his services to the company, then the Keyman policy will kick in and the company will be paid money by the insurance company. So in interview they can ask you who is a Keyman and what is a Keyman insurance policy. There is another term called life assured. You have to be aware of it. Life assured is the person whose life is covered in the insurance contract. So in the event of a contingency, the insured can claim the amount, and in the event of the death of the assured, the nominee will receive the amount. So then there is a plan called money back plan. Money back plan. In this plan, the insured person gets a percentage of sum assured at regular intervals. Instead of getting lump sum amount at the end of the term, they'll be getting a percentage of the money at regular intervals. So usually this policy is suitable for individuals who wish to save through an insurance plan and also maintain liquidity. And in the case of death of the person, the nominee will get the entire sum assured. And of course, the survival benefits are not deducted. So in interviews, they can ask you what is meant by money back plan, and you should be able to answer them. Then there is a term called surrender value. Surrender value is the amount the policyholder will get from the insurance company if he decides to exit the policy before maturity. So as per IRDA rules, IRDA is the regulatory authority for the insurance sector. Life insurance company should not levy surrender charges if the policyholder chooses to terminate the cover after 5 years. So once the policyholder exits the policy, all the benefits will stop to, and the policy will be having various protections, so all those will stop, and the policyholder will be given the surrender amount. So in interviews they can ask you what is meant by surrender value. Then there is a life insurance policy called term insurance. In fact, this is the most traditional form of life insurance policy. So in this, the insured will get the benefit if any contingency happens within the policy term. Now if it so happens that the insured person outlives the policy term and anything untoward doesn't happen, he will not receive any survival benefit. So this is a very cheap policy because it's a very simple policy. There are no additional benefits. Say if you have outlived the policy, say the policy is for 20 years and even you are alive even after 20 years, you will not get anything. But during this 20 years, if something happens, you will get the benefit. Your survivors, your dependents will get the benefit. So we have seen other policies where after the end of the policy, you are given some periodic payments, or during the life of the policy, you are given some periodic payments. So those policies are different. So those money back and those policies are different. This is a term insurance, is a very simple policy. You pay the insurance, small amount. If anything happens during the period of the insurance, the company will pay your dependents. If nothing happens, we will not give you anything. Okay. So term insurance policies are usually available for a period of 10 to 30 years, and they are relatively cheaper than endowment policies and other policies also. So this is a policy that is availed only in the event of death of the insured. So in an interview they can ask you what is term insurance. This is in difference to endowment plan. Okay, endowment policy is a policy that apart from covering the life of the insured, it will help the policyholder save regularly, so that on the maturity he will be given a lump sum amount. Okay, so that amount can be used for children's education or children's marriage, buying a house. So this is a very common form of insurance policy which many people take. Okay, many people take the insurance policy as a means of saving. So every quarter, every month they will put some amount. Say your child is born and after 20 years you're planning to have a marriage. So you take a policy for 20 years, and in 20 years every quarter you pay some amount. So your plan here is, that should something happen to you during this policy term, the policy will kick in and will pay the full amount. The full amount will be given to your dependents. Your child's education will not be suffered. So that is the idea here. Okay. But in case nothing happens to you during this and you happen to survive the policy period, the amount will be given to you on maturity. Okay. So this is an endowment plan. And for these plans, there are tax exemptions under Section 80C. But the premium is comparatively higher than term plan, because not only life cover, you are also getting some additional benefit. So in interviews, they can ask you what is meant by endowment policy and which insurance plan has higher premium, term plan or endowment plan. Endowment plan has a higher premium. So there is one more term in insurance, that is ULIP. ULIP stands for Unity Linked Insurance Plan. So ULIP is a life insurance product which provides risk cover for the policyholder along with investment option to invest in stocks, bonds and mutual funds. So that equity component varies from 0 to 100% depending on the risk appetite of the investor. And the premium paid are invested in the funds chosen by the policyholder after deducting the allocation charges and charges for managing the fund, admin charges and the insurance charges. So the advantage of these plans, insurance plans, is they give the opportunity to earn market linked returns because part of the premium is invested in different market instruments like shares, debentures, etc. So ULIPs offer two benefits. One, they offer the benefit of life insurance and also the benefit of saving at market linked returns. Okay. So in interviews they can ask you questions like what is full form of ULIP, what is meant by ULIP, and what is the benefit of ULIP. So the last topic we'll discuss under insurance is reinsurance. Reinsurance is insurance cover for insurance companies. So we take insurance to protect ourselves from loss. Okay. So what happens if the insurance company itself faces loss? Say for example there's a large drought or large flood and a lot of farmers are affected. And all these farmers have taken agriculture insurance. So all these farmers at once come to the insurance company claiming for money. So the insurance company will be at a loss. So who protects the insurance company if it itself is at loss? There is something called reinsurance. So usually insurance companies make profit, okay, because premiums are fixed in such a manner that the total premium would be enough to pay the total claims even after providing the company's expense. But there is a possibility that in a bad year, in a particularly bad year, the total value of claims will be such that it is more than the premium collected. So to avoid such losses, insurance company take policies from something called reinsurance company. Okay. So in interview they can ask you what is meant by reinsurance and why do insurance companies themselves take insurance. That is, in case of a particularly bad year, it can so happen that the claim amount may be much higher than the premiums received.